The failed smash, the commercial signal failure. It has officially begun. The most important signal in the last 40 years of precious metals trading just flashed across the screen. And if you're relying on the mainstream financial media, you completely missed it. They are talking about the S&P 500. We are talking about the end of the suppression era. Yesterday, at exactly 8:30 a.m. New York time, the bullion banks declared war on the silver price. They didn't issue a press release. They didn't hold a conference. They did what they have done every single time silver threatens to break out for the last 3 decades. They used the limit down algorithm. They fired a massive coordinated sell order into the COMEX futures market. We are talking about billions of dollars in notional paper silver dumped in milliseconds. The goal was simple: execute a liquidity flush. They wanted to shatter the psychology of the market. They wanted to trigger your stop-loss orders. They wanted to paint the tape red so that the technical traders would panic and sell their physical positions. But something historic happened. Something that hasn't happened since the Hunt brothers cornered the market in 1980. It didn't work. The price didn't collapse. The red candle appeared, yes. The volume spiked, yes. But instead of a $2 or $3 crash, the market simply opened its mouth and swallowed the liquidity. The dump was absorbed instantly. Within minutes, silver was trading back at the pre-smash level, and then it proceeded to rip right through the resistance like a hot knife through butter. This is what we call a commercial signal failure. The machine that suppresses the price has jammed. The gears are grinding. The algorithm is confused because the input, dump 5,000 contracts, did not result in the expected output. The price drops 3%. Instead, it resulted in a buying frenzy. This failure is the tipping point. It proves that the Maginot Line of the paper shorts has fallen. For years, the banks relied on the fact that they had infinite paper to sell, but yesterday proved that the market has infinite appetite to buy. The smart money, the sovereign wealth funds, the Asian industrial giants, the stealth whales, saw the liquidity spike not as a reason to sell, but as a gift. They used the bank's own selling pressure to fill their buy orders without spiking the price to $100 immediately. The banks effectively subsidized the accumulation of their own enemies. Think about the implications of this. If the banks throw their best punch and the market doesn't flinch, what do they have left? They're out of ammo. They are now naked short in a rising market. They have sold promises they cannot keep, and the market is calling their bluff. We are witnessing the transition from a speculative phase, where price drives sentiment, to an accumulation phase, where shortage drives sentiment. The shortage is screaming. The silence of the banks this morning is deafening. They know they just lost control of the thermostat. The suppression era ended the moment that dip was bought. The gamma trap, the mechanics of the doom loop. To understand the violence of what is coming next, you have to stop looking at the spot price and start looking at the plumbing of the derivative market. You have to look at the gamma wall. Most people think the price of silver is determined by supply and demand. It is not. It is determined by the leverage applied to the supply. And right now, that leverage has turned into a trap for the banks. The part of market makers, the big banks who facilitate trade, have sold millions of ounces worth of call options at the current strike price. They collected the premiums, betting that silver would never, ever cross that line before expiration. They treated those premiums as free revenue. They thought they could suppress the price forever. But because the smash failed yesterday, those options are now deep in the money. This forces the banks into a gamma trap. Here's the mechanics of the nightmare they are facing. The market maker must remain delta neutral. If they sold you a call option, a bet that prices go up, they are effectively short the market. As the price rises, their short exposure grows mathematically. To neutralize this risk, they must buy the underlying asset. They must buy futures contracts. But here is the doom loop. The price rises. The banks have to buy futures to hedge their gamma exposure. Their buying drives the price higher. They have to buy more futures to hedge the new price. The price goes even higher. Usually they smash the price to break this loop. They force a sell-off to get the price back below the strike level so the options expire worthless. But because the smash failed yesterday, the loop is accelerating. The shorts are now fueling the very rally they are trying to kill. We are seeing open interest explode to record highs, but the price isn't dropping. This is the smoking gun. It means new shorts are entering the market to defend the wall, and they are being swallowed alive by the gamma buying from the hedging algorithms. The computer is confused. It is programmed to sell into strength, but the strength is relentless. The robot is fighting physics, and physics is winning. We are watching a vertical melt-up in real time. The resistance levels that have held for a decade are dissolving. The $30 level, the $50 level, the $85 level, they are just speed bumps now. The gamma buying doesn't care about valuation. It is forced buying. It is a robot executing code. If price X, buy Y. The banks are trapped in a room with no exit and the water is rising. Every time they try to sell paper to bail themselves out, the water rises faster. This is not a market. It is a crime scene where the perpetrators are slowly realizing they have locked themselves in the vault. Why did the smash fail? Why didn't the price crash like it did in 2011 or 2020? Who stood in front of the steamroller and bought the dip with such ferocity? It wasn't retail investors. It wasn't the Hunt brothers. It was Shanghai. We have to look at the geopolitical chessboard. We have been tracking the arbitrage gap for weeks. Right now, the price of physical silver on the Shanghai Gold Exchange, SGE, is trading at a massive premium to the COMEX price in New York. We're talking about a spread that converts to roughly $8 or $10 per ounce. Think about what that means. It means silver is valued significantly higher in the East than in the West. This creates a vacuum. It creates a giant sucking sound. When the New York banks tried to smash the price yesterday, they effectively put silver on clearance sale for the Chinese industrial complex. They made the arbitrage trade even more profitable. A trader could buy the cheap paper silver in New York and sell the physical contract in Shanghai for a guaranteed risk-free profit. This is the Shanghai put. It is the concrete floor under the market. Every time the West sells paper, the East buys physical. They are using the arbitrage to drain the Western vaults. We are hearing reports that the load-out queues at the COMEX are lengthening. Metal is moving from registered, available for delivery, to eligible, private storage, or leaving the system entirely. The flow is one way, West to East. China is draining the West because they know the dollar is failing. They see the U.S. debt spiral, $36 trillion and counting. They see the interest payments consuming the tax revenue. They know the dollar is on a path to hyperinflation. So they are converting their massive trade surplus into hard assets. They are not buying U.S. treasuries anymore. They are dumping them, and they are using the proceeds to buy gold and silver. But the Chinese demand is different. It is price inelastic. A Western hedge fund buys silver to make a profit in dollars. If the price drops, they sell to stop the loss. China buys silver to use it. They need it for their massive solar build-out. They need it for their electric vehicle dominance. They need it for their military. If the price goes up $5, China buys. If the price goes up $10, China buys. If the price crashes, China buys more. This is the nightmare for the short sellers in New York. They are used to shaking out weak retail hands. They do not know how to fight a sovereign superpower that views silver as a matter of national security. The Shanghai Express has broken the banks. The failure of the smash yesterday was the West realizing it has run out of inventory to feed the East. The vault is empty and the dragon is still hungry. The industrial panic, the supply chain snap. Now, let's leave the charts and go to the real world. Forget the price for a second. Look at the factory floor. The reason the smash failed is because the industrial users have panicked. We need to talk about TOPCon solar technology. This is the new standard for solar panels. It is more efficient, but it uses 50% more silver than the old PERC technology. The solar industry is consuming silver faster than the mines can pull it out of the ground. Companies like LONGi Green Energy, Samsung, and Tesla operate on a just-in-time inventory model. They rely on the market to deliver metal exactly when they need it. They don't hold months of inventory because that ties up capital. But yesterday's volatility terrified them. They saw the banks try to crash the price and fail. This told them that the supply is tight. If the price can't go down, it must go up. So what did the procurement officers do? They shifted to just-in-case inventory. We are seeing market on close, orders from industrial buyers sweeping the floor. They are buying physical metal not because they are traders, but because they are terrified of running out. This demand is price inelastic. The cost of silver is a tiny fraction of a solar panel or an electric car, maybe $20 per unit. If silver goes to $100, the cost of the car goes up by $5. It is negligible. They don't care if silver is $85 or $100. They care if the assembly line stops. If the price goes to $100, they will still buy. If the price goes to $150s, they will still buy. This creates a concrete floor under the market that the paper shorts cannot break. You cannot spoof a shortage. You cannot print physical metal. The industrial panic has removed the elasticity from the market. The shorts are trying to bluff a player who is holding a royal flush. We are also seeing the force majeure whispers in the wholesale market. Refineries are struggling to source 1,000-ounce bars to melt down. The miners are not selling. The miners are holding back supply, waiting for higher prices. They see the desperation of the banks. Why sell at the current price when the bank is trapped and will have to pay double next week? This creates a supply strike. The $85 panic sell has effectively frozen the flow of metal. No rational seller wants to part with real silver at a manipulated paper price that just failed to hold. The banks have inadvertently accelerated the timeline. By trying to stop the rally, they prove the rally is unstoppable. They remove the doubt. The industrial giants are bypassing the COMEX entirely and going straight to the mines. The off-exchange deals are exploding. The real market is going dark. The unobtainium phase, the retail reality. So what does this failed smash mean for you, the physical holder? It means we are entering the unobtainium phase. The disconnect between the spot price and the must-start real price is about to widen into a canyon. The banks might try to keep the screen price suppressed to save face, but try to buy a monster box of silver eagles tomorrow. You will see one of two things. Out-of-stock signs appearing everywhere. Premiums exploding. Dealers are terrified of replacement cost. Imagine you are a bullion dealer. You sell a coin today for the spot price plus a small premium. But tomorrow, the price gaps up $5. You now have to spend more money to replace the coin you just sold. You lost money on the trade. So, what do dealers do in this environment? They widen the bid-ask spread. They jack up the premiums to cover the volatility risk, or they simply stop selling. They go bid only. We are hearing rumors that major wholesalers are putting retailers on allocation. This means the local coin shop can only order a fraction of what they want. You want 10 monster boxes? Sorry, you can only have one. This is the force majeure scenario for the retail investor. You have the cash in your hand, you want the metal, but you can't get it. The supply chain has snapped. If you're sitting there with cash, waiting for a pullback to buy, you're playing Russian roulette. The failure of the smash suggests the next move is a gap up. We could wake up on Monday morning to find silver trading significantly higher with no way to enter the market. The spot price is becoming a ghost number. It is a reference point that nobody can actually trade at. The real price is being discovered in the back alleys of the physical market, and it is much, much higher. This is why we tell you to stack now. The window is closing. The sold out sign is the defining image of the unobtainium phase. And after the banks failed to smash the price yesterday, that sign is being printed right now. So, here is the final verdict. It is over. The suppression is dead. The banks are trapped. We are witnessing the greatest wealth transfer in history. It is flowing from the paper assets to the hard assets, from the debt-based system to the resource-based system, from the trusting to the prepared. Where does the smart money go now? If the physical window is closing, where do we go for leverage? We rotate into the miners. If the banks can't suppress the price, silver goes to its true value. And at true value, the mining companies are printing money. Let's do the math on a hypothetical miner. Let's say their all-in sustaining cost, AISC, is $20 an ounce. At $25 silver, they made $5 profit. At current prices, they are making massive profits. That is a 1,000% plus increase in free cash flow. But their stock prices are still asleep. They are trading at valuations from 3 years ago. Wall Street hasn't done the math yet. This is the miner pivot. This is the leverage play. We are moving capital into the unhedged miners, the ones who didn't sell their soul to the banks, the ones in safe jurisdictions like Canada and the US. Avoid the miners who sold their future production at $30 to survive the bear market. They are dead to us. And finally, the exit strategy. We are not holding forever. We are holding for the wealth transfer. We are watching the gold to silver ratio. Right now, the ratio is high. Silver is cheap relative to gold. When the ratio hits 30.1, we wake up. When the ratio hits 15.1, we execute the swap. At 15.1, silver is historically expensive relative to gold. That is the moment of maximum opportunity. That is when we walk into the dealer, hand over our volatile silver stack, and trade it for stable gold. By playing the ratio, you can effectively triple your gold holdings without spending a single extra dollar. You let the volatility of silver do the work for you. You ride the wild horse up the mountain, and then you switch to the sturdy carriage at the top. That is how you cement your dynasty. You don't sell for dollars, which are dying. You swap for better assets, you swap for land, you swap for income-producing real estate. Do not get blinded by the dollar sign. $100 silver is meaningless if a loaf of bread is $20. Focus on purchasing power. Focus on the ratio. The banks panicked. They tried to smash it. It didn't work. The vault is draining. The shorts are broken. The run has begun. Hold the line. Subscribe to the channel because we are tracking the gamma wall every single day. We will tell you when the next desperation move is coming so you can profit from it. Class dismissed.